Hey there, everybody. Thomas with Basecamp Trading. It is Friday, June 28th, and we're going into G20 Summit. But with that being said, I want to talk a little bit about a trade that we've been following and been trading here, a market we've been trading for the past several months, if you remember at Basecamp, and that was a long-term short in Hogs. And I want to break down why we were bearish Hogs here the past few months. So just like we talked about in many of the other videos, we discussed what we call a run the stops. Now, before I dive into that again, make sure you hit that like button and click subscribe if you haven't already done so to the YouTube channel so that you can get notifications every time we upload new videos so that you are able to check them out and learn more about trading. But with that being said, the reason we were looking at a run the stops in Hogs is we had pivot high resistance up here at 91.8. And you see we broke through it way back here in March, broke through, pulled back, closed down below it. And then April, we did the same thing. Broke through, pulled back, closed below. And this time we left a really long topping tail and had what we call a shooting star pattern. That's the same thing we've been looking at, by the way, for potentially forming on a weekly in gold this week. Then we triggered last month. The trigger is when you break the low of that price bar. And we left yet again another topping tail above that resistance, showing an unwillingness to sell or unwillingness to rally above that 91.8 resistance. Then we followed through and just proceeded to sell off through the floor. And we hit the targets as of 2 days ago. We were saying, okay, market's now hit the targets. Time to be taking profits. We'll wait and see where it gets to from now. But overall, played out really, really well. So the thing that we're watching for now with Hogs is we have a bullish divergence. But one thing that we pay attention to is we always do what we call multiple time frame analysis. So with Hogs, we had the run the stops here on the monthlies, which tells us long term it should go lower. But if we want to time our trade a little bit better, how do we do that? Well, one thing we looked at, if you go down to a daily price chart here, is we had a daily head and shoulders that formed within the context of the monthly run stops. So you can see your daily here, left shoulder, head, right shoulder, and that gives you a break point to trigger your entry at 88,250. And then you had a bear flag and what we call last kiss right here. That happened 2 days later, would have had you selling right here about 87,426. And each one of these trades would have had much less risk based on where we place our stops for these types of setups compared to trading the monthly, where we would have been putting our stop all the way up above the high of the monthly price bar. So as a whole, we went from monthlies down to dailies. It gives you a much lower risk amount because we're placing our stop above previous price bars high. So we have just a couple of points risk as opposed to 10 points, 20 points risk. And gives you much better reward risk ratio because we're still trading within the context of that monthly setup. So we have a longer term outlook for this thing to accelerate lower. So that's a breakdown of Hogs, how we've been trading it here recently. Now, again, targets are hit, but if you want to get these types of setups and these types of signals, make sure you join basecamptrading.com. There's a link down in the description where you can get an entire month trial for only $7. Come in here and you can see the end of day videos. You can see our swing trade outlooks like this. But that's it for today, everybody. Until next time, happy trading.